Profit or loss statement. When we look at the profit or loss statement, the first thing which we seek to answer is what's the waterfall? Means for every rupee of sales which the company makes, which is the raw material cost, how much percentage is the employee cost, how much percent is the other overheads, the EBITDA margin of the company, the interest cost vis-a-vis the sales, what is the depreciation which the company has to provide, what is the profit before tax, what is the taxation impact, and net profit after tax, followed by the percentage of profits which are distributed as dividend, and what is the retained earnings of the company. Every rupee of sales which flows to the company's profit or loss statement. Profit or loss statement is a period statement. We always say profit or loss statement for the period ended 2024. So what is the waterfall? How the sales translates to net profit can be reviewed from the profit or loss statement. The ability to pass down cost we already touched upon. The operating leverage. Operating leverage is a corporate finance concept. What it means is that how quickly the company is able to break even and raise its fixed cost. Cost can be broadly broken up into fixed cost and variable cost. Once the company meets its variable cost, how quickly the company meets its fixed cost. The higher the component of fixed cost and the higher the contribution margin or the margin after variable cost, the better the operating leverage of the company. So if you look at the P&L, the raw material cost, the direct expense is a variable cost, the selling and administration overheads and the fixed cost and the employee cost to some extent, to almost large extent, are fixed cost. So the lower the percentage of variable cost vis-a-vis the sales and greater the break-even ability of the company at a lower sales, the better the operating leverage of the company. So that can be known from an analysis of the profit or loss statement. The impact of debt on overall operations of the company, in turn leading to financial leverage. What is the impact of debt? Means the interest cost as percentage of EBITDA, as percentage of the turnover. Is the company earning sufficient to service the interest on its borrowing which it has made? What is the coverage? If my interest cost is 100 rupees and the earnings before interest and depreciation is, let's say, 400 rupees, that means my interest coverage ratio is 400 divided by 100, which is 4 times, which means that I have 4 times the ability to service the existing interest. Higher the interest coverage ratio, better it is. The ability of the company to service interest or the impact which debt has on the overall operations, also referred to as the financial leverage, can be assessed from the P&L. The impact of taxation, the percentage profits paid out as dividend and the percentage profits retained earnings to fund its future growth plans. This would also flow from the profit or loss statement. The balance sheet is a point statement, or the cash flow statement is a period statement, which means it will be cash flow for the period, financial year 23-24, but balance sheet as on, which means that balance sheet is a statement of balances. Balance sheet read with the cash flow statement and the profit or loss statements helps us figure out the financial leverage. How much is the incremental sales are funded by receivable? So if there is a sales increase from, let's say, 100 to 200, whereas the receivables have increased drastically and not in proportion to the increase in sales, which means that bulk of the sales have been funded by receivables. How much increase in stocking was required to deliver incremental sales? How much of the incremental sales are funded by creditors? The balance sheet reports the creditors, receivables and the stock figures. This analysis can be done only through the balance sheet by referring to those figures and calculating them as percentage to the turnover. The capital efficiency in terms of the fixed asset turnover, how much fixed assets are used to deliver a turnover, and the working capital flows from the analysis of the balance sheet. The return ratios, what is the return on capital employed and what is the return on net worth, which are two principal ratios primarily important from a corporate finance perspective and from an investor perspective. If the return on capital employed is lower than the return cost of capital of the company, which is a combination of the cost of equity and the cost of debt based on the proportion in which the funding sources are used, whether equity or debt, then in that case, if the return on capital is higher, which means that the company is adding value to its stakeholders. If not, then the company is losing value. What is the return on net worth? The net worth means the return on equity. Return on net worth and return on equity are synonymous terms. The numerator in either of the ratios being the return number and the denominator being the capital employed or the net worth. When we have the denominator as the capital employed, the numerator would be the return available to equity shareholders and the return available to debt holders. What is the return available to debt holders? Interest. What is the return available to equity holders? Profit after interest and depreciation. The EBITDA or the EBIT number is used for calculating the return on capital employed, whereas for the return on net worth, the PAT is used or the profit after tax is used because that is available to the equity shareholders. Most non-accountants have a tough time to read annual reports, and if you know basic mathematics, I am giving you a scheme whereby you can understand the annual report. We all know that our net worth or our capital is equal to our assets minus liability. So if you remember this one principal equation, capital is equal to assets minus liabilities. All the other things are subsidiary to it. For example, the profit or loss is income minus expenditure. We can further expand this income as income from operations, other operating income, minus expense includes raw material, overheads, employee cost, selling and administration overheads, EBITDA. Both sides of the balance sheet, the side and the asset side, the sources of the funds and the application of the funds always have to tally. So look at the sources of the funds and the sources and application as an equation. So if you can lay down the financial statements in the form of an equation, with primary equation being capital is equal to assets minus liabilities and all the other equations being subsidiary equations, we will understand that it is much more easier to understand and compute annual reports.